evening. We have Rosch, who's going to be speaking tonight. But before I introduce him, I'm going to give a couple of brief announcements so that you guys can be accustomed to some of our upcoming events that we have. So real quick, who's Quest Trust Company? If you don't know who we are, we're the leading provider of self-directed IRAs across the nation. But not only are we a custodian, we're also an educator as well. So from events to articles to presentations just like this, we're always providing quality education so that you guys can take control of your retirement and build wealth by investing into things that you guys know and understand. So as you can see here, we do hold alternative assets, most commonly being real estate, promissory notes, or private entities. But more recently, we're seeing cryptocurrency, oil and gas, all sorts of things. And lastly, fast and friendly service with no expedited fees. So always making sure that your experience is the best that it can be without an additional charge as well. So real quickly, what's a self-directed IRA? For those that don't know, a self-directed IRA is really not any sort of fancy type of IRA. It's a normal IRA that just lets you invest in what you know best, like private assets. So self-directed is actually just a marketing term, and it's used to describe the type of assets that you can purchase. So moving beyond stocks, bonds, mutual funds, things like that, to invest into, like I said, real estate, private entities, or notes and things like that. And why would somebody want to do this? Well, mostly it's going to be for diversification. It lets you move beyond publicly traded assets to invest into things that you may, have a better understanding of. And of course, it's going to be that tax benefit. Depending on what account you have, you're going to get that tax deferred or tax-free benefit whenever you take those distributions. And then there's going to be that social investing aspect, right? Whenever you're investing into a property, maybe in your community, you're fixing up that house in your neighborhood. You're making an impact around the area that you live. So there's that social investing aspect as well. But like I said, we also offer a lot of educational resources from the self-directed IRA webinars that we put on Tuesdays and Saturdays to the socials like tonight, and also bigger conferences like the Quest Expo, which I'll talk about in a few moments. We also have a networking happy hour that's really awesome. It's the fourth Wednesday of every month. It is virtual, so if you do want to join from the comfort of your couch, you have that option. But it's a really great place to kind of meet other people, make connections to do deals and things like that, maybe beyond your local community. But if you do ever miss a webinar, we always live stream them on our Facebook and on our YouTube page. So you can go back and rewatch them if you've missed them. Maybe you have a friend that you want to share a class with. You can send them that link and it'll allow them to watch it as well. So the Quest Expo, as I mentioned a couple of seconds ago, is the biggest conference that we put on all year. And I'm going to spend about a minute or two here on this slide, just because I really want to let you guys know about the value that y'all will get at the Quest Expo. This really is the biggest event that we put on all year. I know there's about 20, 30 people here in the room tonight. At the Quest Expo, you're going to see hundreds. We've already sold about 500 tickets, and that means that there's going to be attendees, expo vendors, expo speakers, questies, and all the likes at this event. And it's going to be a really great place for you to not only get the education that you need to take the next step in your alternative investing portfolio, but also meet people that you may want to network with to do deals with in the future. Whenever you have this many people in one room, there's always opportunities to get your next deal and to make those connections. So we know that this is going to be a great event. If you want to get tickets, we have an extra special coupon code that we can give you in the back of the room. It's also right here. But if you want to, take the stress out of getting your ticket later, we can get you registered tonight really quickly. Emmett Smith is going to be our special guest speaker. So I know that a lot of you people probably know him from football, but what you may not know is that he actually took the leap from football to an entrepreneur in real estate by leveraging his network and the education that he learned. And he's going to be telling his story at our expo as well. So if you want to get a ticket to that, feel free, like I said, to ask us in the back or scan the QR code. Question? We will have a recording. Unfortunately, you have to actually be an attendee in person to hear Emmett Smith's portion. His portion will not be on the recording. So if you do want to hear his presentation, you do have to be at the expo. Great question. So lastly, if you do have any additional questions or want to maybe get some more information about self-directed IRAs or the events that we put on, you can scan this QR code. Of course, email us, call us, go to the live chat on our website, and we'll be able to help you out. So without further ado, that is when I will go ahead and bring up our special guest speaker, who's going to be talking about the state of the union with multifamily. So without further ado, let's give him a round of applause.
So I guess I should start with my background, give a little intro, but I also want to make it very interactive. So at any point, if you guys want to shout out or, if you want to raise your hand, ask some questions, or even more importantly, what I really enjoy about these events, Quest in particular, I've come to these in Houston, Austin, and Dallas, and it's just the people that I meet. So every time I come around to these events, I meet new folks, and they're all pursuing different investments. I was just talking to Mohammed a few minutes ago, and he was telling me about investing in ATM cash machines. So it's just a very eclectic crowd. So I want to make it very interactive because we can definitely learn a lot from each other. But I suppose now, quick background. So I work for the Casoro Group currently, which Jessica also works for the Casoro Group. So Jessica, raise your hand. A wonderful colleague of mine, definitely, a very insightful person. And the Casoro Group, we manage $220 million worth of apartment complexes currently. We have a few different capital sources, one of which is the Onyx Fund. That's exclusively for qualified purchasers. So that's mainly for institutional investors. And then also the REIT. So it's a real estate investment trust that's a capital provider and involved in all the deals that Casoro manages and all the complexes that we have under management. And the REIT is available for accredited and non-accredited investors. The minimum investment is only $2,000. Of all the assets that the REIT is invested in, it totals 2,224 apartment homes under management, and that's spread out across San Antonio, Houston, DFW, specifically Irving, and one apartment complex that we have out in Oklahoma City. So it's, we're all from Texas. We're here in Austin. It's the cities that you guys all come from and live in, investing in your own community. Before Upside Avenue, I was a real estate developer for a local construction company in Houston. So I put up 5 buildings in particular, 3 of which were in Austin, 1 in Dallas, and then a 4th was a commercial garage for the Austin Bergstrom International Airport. And before that, I was with PPHB Energy Investment Banking. So that was an oil and gas focused boutique, M&A specifically, sell side, basically selling oil field service companies to publicly traded oil field service companies like Halliburton and Schlumberger. Oil and gas was a lot of fun, but it's an extremely volatile industry, whereas real estate is much more stable, and it's just a tremendous amount of opportunity that I don't think is going to go away at any point, because we all need homes. So that's a little bit about me, but I want to make it interactive, and I see some friendly faces. So before I get started on the presentation, which is essentially just the state of the multifamily market, so really just going to look at Austin, Houston, Dallas, and San Antonio, so the 4 major cities of Texas, and kind of see different pricing trends going back from 2017 to see if are there any better deals in one city over the other, or are certain cities maybe more of a growth strategy versus other cities more of yield plays. So things of that nature, and then also just some general things as far as multifamily and affordability, and also tying that into population growth. So it'll be very data heavy, but at the same time, it's what story does the data tell us? So before I get into it, I'm just very curious, looking at all the faces over here, if anyone wants to share, what has been your investment experience, any particular asset classes or focus, single family or multifamily, retail or office that you'd like to share with the rest of the room, or rather, if not what you've previously or currently invested in, what you're hoping to invest in going forward, any areas of focus, and then maybe afterwards, we can connect with each other for folks that are looking for similar things. So any volunteers, or do I have to call on folks? Brandon?
Yes.
Thank you. Please tell us.
So I have a triplex in the Woodlawn Lake area of San Antonio.
Okay.
On a double lot. Hello? Can you hear me? Hello?
It's for the people online, yeah.
Okay. So yeah, I have a triplex in the Woodlawn Lake area of San Antonio, and it's my first purchase. I'm living in one of the units. I'm renovating them all to the studs almost, and creating 2 corporate rentals. And later I'll want to build on the other lot. So that's just kind of a personal project. I work a full-time job, so I'm fitting that in. But I also want to buy apartment complexes, at least 100 units. I'm looking at deals in Houston, San Antonio, Austin, and Dallas. So we've been underwriting a few, but we're just looking for more deal flow so that we can find that needle in a haystack.
Awesome. So I've heard really good things about San Antonio. I'm particularly a big fan, not just from an investment perspective, but also just from a quality of life. And we actually, Upside Avenue, just invested $534,000, so just a little bit over $500,000 into an apartment complex that's over in San Antonio. And we also have some land over there that we're developing Class A on. So very bullish on San Antonio. It seems to be an area where it's relatively cheap compared to New York or San Francisco, but by no means a small town. Definitely an area that keeps growing. And we'll actually look at some of the population data for San Antonio later. But anyone else care to share kind of investment experience, what you've been working on or plan to work on, would like to work on in the future? Brian, please. Brian's actually a good friend of mine, a pretty good mentor, and a very active realtor focused on single family and land investments here in Austin and Houston. So the guy, I don't know how he does it, but he lives in 2 cities at the same time, I swear.
Okay. Hi, I'm Brian Thompson. This is my wife, Ligaya Thompson. We are licensed Texas real estate agents. Sometimes we have brokers that say, hey, you got to stick in this one market. But again, we're Texas real estate agents. We're from Houston originally. We moved out of Austin about 4 years ago. But personally, before we became agents, we started investing in land and single family homes to rent out. Our biggest one was just nothing special, nothing unique, but it was a triplex in Dignity in San Antonio. The largest acreage we've owned was 4 acres out in Houston. But we basically stick to rental homes. Nothing large as 100 units, but pretty much all the funds is personal funds or family funds. But I like to poke at our broker, Keller Williams. Mr. Keller, he used the term buy dirt like not too long ago. And I've been saying that to my family and friends, buy dirt so you can easily acquire that dirt at a certain cost, then later on resell or quote unquote flip that dirt and then get you some rental properties. I've told Rosch that the only time I want to sell a home or land or a piece of lot is if I could split. So I like to just keep everything simple, just nothing extravagant. I'm not that big jackpot investor or real estate agent, but it's just a matter of doing what's been proven that has worked. And so what I've liked, just buy land, sell the land, get your rental property, put a tenant in it, renovate it, refinance and cash out. I mean, some of you guys are probably looking at me like, that sounds familiar, but it's doable. Everyone in this room can do it. Some of the terms might be intimidating, but what you practice often is what you're going to be best at. So the fact that you guys are in this room, it's just getting started. I'm not the speaker. I want to get back to Rosch, but he knows I can get on these tangents because I just believe real estate just puts family legacies and individuals in a different trajectory as far as financial capabilities and options going for your family. So that's why I can get in these tangents because I've personally seen it done rather simply. The concept is simple, but there's work that needed to be put in. But again, I'm a real estate agent, so I have access to San Antonio, Houston, and Austin, and those in Central Texas. The database, I have access to it, my wife and I. If y'all want to speak to us after the show, let us know.
Awesome. Thanks for sharing. And have some folks that I want to call on. Garv, I'm going to save you for the end of the presentation, though. Don't worry. But before I get started, have to give the standard disclosure. So, it's just for informational purposes only. Not here to sell any securities, just to provide information. Most of the information that I'm showing you comes from the federal St. Louis branch specifically, and as well as CoStar for the multifamily data. But as far as tax and legal advice, please consult your attorney. And now that we got the boring stuff out the way, we can come and check out multifamily. So this is a bunch of numbers. Maybe I should actually take a step back and kind of, instead of just throwing a bunch of data on you, it helps, I feel, to, rather than just look at massive amounts of data and try to find trends, go in specifically with what specifically are we looking for. So now I have to take a further step back as far as valuation is concerned and share with you, not my theories, pretty much the academic standard for valuation, one of the most common approaches to investing, which is the income-based approach, but not in any ways to exclude the growth approach. So essentially, almost every single valuation method, if you think about it, and what I'm referring to is pricing an asset. So whether it's multifamily, whether it's office, whether it's a small business, ultimately all asset prices tie back down to their cash flow. So we buy an asset because of the cash flow it produces. Now, there are a lot of different instances where folks may say, but I'm not buying for cash flow. Say, for example, a startup. But even if you look at it, that actually ultimately ties down to its cash flow. So Uber, for example, before it became a publicly traded company, it may have not been cash flow positive, but the venture capitalists were investing in it on the expectation that for all the drivers and all the rides that it's giving and all the revenue that it's producing, at some point in the future, it will produce positive cash flow. And they may drag that out for years and years and years and instead favor large growth. But ultimately, it needs to produce cash at some point in the future to derive any sort of investment value. Multifamily, fortunately, we don't go through those phases of burning cash like a tech startup would, for example. Multifamily produces cash, and most people buy it for the yield, but also at the same time that value add or forced appreciation, people refer to it, where you deploy additional capex to renovate the units. So essentially provide upgraded amenities, just better homes for folks to live in. And then in exchange, they provide you with higher forms of rent payments. So even value add, when you think about it, it may not be producing income right away. Its dividend yield might be pretty low. But the reason that you're able to sell it for a higher price is because through those renovation capabilities and programs, you've increased its cash flow. So that's why someone else would want to buy it for a higher price. So whether you're looking at the cap rate, whether you're looking at the dividend discount model, whether you're doing a discounted cash flow is king in every asset to determine its price, to make sure that you're getting a good deal, to evaluate the potential return that you get from it. It's predicated on the cash flow it either has proven historically or you believe it will pay in the future. So we looked at, now I'll turn to the slide for Houston. So to look at basically multifamily in any one city, we don't have the data to show exactly what net cash flow each complex produced to its owner. But fortunately, we do have readily available the rent that has been charged in a market area on average from large data sets. So fairly accurate, we can tell what the rents are in any given market. This specifically is from CoStar. Reason I'm pointing out rent is because although we don't know the exact net cash flow that was produced by these assets in that market, we do know the rent. And if we know the rent, it's basically a very close proxy for what the cash flow would be, right? The more rent you charge, generally, the more cash flow, net cash flow you should be receiving after all your expenses. So that's why each slide, we're just looking at the rents in that city as well as the asset prices. So I'm starting on the left. In United States, we have the price per unit. So we collected the sale price for different apartment complexes, but each apartment complex has perhaps 100 units. Another complex might have 200 or 300 units. So just to standardize the data, we took the sale price of that apartment complex divided by the number of units. So for the United States, for example, if we go back to 2017, so this is all just a 5-year period on a quarterly basis, all the way up to today, you're seeing it started around 120, 130, 140. So very cheap considered to today's prices. So it's no surprise, the prices in the multifamily market have, I guess the best word is overheated in terms of where we are today relative to where we are in the past. But if rental rates have also increased proportionately, that doesn't necessarily mean that we're going to get any less of a rate of return. So that's why we're looking at price per unit and the rent per unit. So the next 3 columns over, Class C, Class AB, and then all of Houston. And then the other 3 columns on the end is our studio, 1-bed, 2-bed, 3-bed. So basically for Houston, around 2017, you could get a 2-bed, and on average, of course, it's an average, right? So certain parts of the city, generally in the downtown areas, are going to be on the higher end or above that. But on average, in Houston, for a 2-bed, $1,200 5 years ago. Fast forward to today, $1,400. So you're paying $200 more. So question is, what's going up faster, rent or the asset price? Because exactly. So what does that mean for our returns going forward, Mohammed? You be the bearer of the bad news. I won't say it directly. That doesn't necessarily mean that you're not going to find a good deal. It just means that there's a lot more competition. So that's why we're looking at, prices and rent. And again, these numbers are on average, right? So we're looking at each different city, but it doesn't necessarily mean that one city is better than the other. Although we will see in which city specifically between our 4 competitors, which one is growing rents at a faster rate and which one is trading at cheaper valuation multiples. But my point is, you can still find a good deal. You can still make a great investment, especially if you find an asset in a city that maybe because of your local knowledge or maybe because of your attention to what's going on with nearby development. For example, in Houston, the Texas Medical Center is undergoing like $1 billion expansion. So they're putting up more hospitals, and they're also expanding the Texas A&M Med School. So just, these little things, point I'm getting at is, even though the data is showing that, hey, things are getting pricier, which is true, it's the reality we have to accept, with your local knowledge, you can still find a really good deal that other folks have overlooked, or in other words, has been mispriced for one reason or the other, or there's value potential in the future that other folks just haven't caught up on yet. So next, we'll fast forward to Austin. Yeah. Good question, Mohammed. Always looking out. So that's the compound annual growth rate. So basically, what that says is prices are going up at this percentage per year. So literally, believe it or not, the data is there. I'm not making it up. In the US, for example, you see the CAGR was 12.6%. That means that if you took that first price back in Q1 of 2017, 123,000, and you multiply it by 1.12 each year, not quarter, so 5 times, you'd get up to essentially what your annual growth rate has been. Yeah, so it does double over time. Exactly. So if you invested back then, or even went further back to 2010, or if you were one of those very wise, tenured folks who in the crash invested, you wouldn't be here listening to me right now. You'd already be a millionaire. So there's that. But here's the key that Mohammed, thank you for pointing out is, and you already touched on it, right? What's going up faster? Asset prices. Rents are not going up at the same rate. So we look here in Houston, say Class C, Class AB, you're seeing 12, 15, as low as 9. So generally around 12% on average for Houston is the increase in the prices of those assets. But rent, our proxy for cash flow, is only going up at most 3%. So that's why, the whole point of it is just telling us right here the valuation multiple. So we're just taking the asset price divided by the rent that it produces. So basically what this is saying is for every $46 you invested back in 2017, you're getting $1 back of rent as our proxy for cash flow. Today, to get that same dollar back in rent, you have to spend upwards of $60, $70 just to get that same dollar of rent, of cash flow back to you. But let's check out Austin. So just jump straight to the point here on the bottom. What it shows us is what we kind of already intuitively know living here in Austin. Unlike Houston, so I'm going to go back a slide where we had 3% at most rent growth. Austin actually is growing up upwards of 5% of rent growth. So asset prices at a similar rate. So prices have been increasing at a similar rate, at least for multifamily. Single family is a different market. So don't confuse the two, because those growth rates are insane. But for Austin, your asset prices were going up at similar rates as Houston. But your rent growth was going up at a faster rate. So the returns, what this may imply in aggregate, not specifically to a certain deal that you might find, but in aggregate, the rate of return in Houston is diminishing at a faster rate than we have in Austin, because Austin is able to increase rent growths more so than Houston is doing so. And this brings up a bigger question, though, is, if it's growing at a faster rate, rent specifically, so what tenants are paying, question then, folks have to ask is, especially us as investors, is, it can't just keep going on forever. At some point, and we'll look at it later, is how are household incomes growing? Are their incomes also growing rather? Because if they're not, then it might be a little bit of a trouble going forward. Yes, sir.
Kind of what I was hoping to kind of ask you is that, have you pulled it out when you take, like, let's say the last 2 to 3 years versus the growth rate? In other words, you can kind of tell on this one, it's pretty apparent. Austin has stayed pretty consistent all the way up until like pandemic time. And I guess my question, kind of my more knowledge in the residential area, right? And a lot of emphasis on the perceived inflated prices across the country, but particularly in Austin. And I guess my question is more along the lines of the asset prices on this multifamily. If you see a similar kind of trend, in other words, have they increased so fast, so quickly, that the expectation of being able to maintain that is probably not going to happen? And if so, what type of correction might be on the rise? Does that make sense?
So that's why we're going to look at it later. How it's a great question, though. And I see where you're getting, because it's a concern in my mind too, right? Is, can we continue to expect these growth rates going forward, especially if we're investing and we're underwriting at these growth rates, but they don't pan out, then, we're risking our money. Exactly. But that reminds me of one thing is, I don't show it here, but when I was looking at it earlier today, a lot of the growth, it's not evenly throughout the 5 years. So there was some distortion where, and I think it was pretty much, I don't want to say it's because of COVID, but quite a coincidence. And we all saw this in the single family market too. So it's a little bit unfair because I'm showing you the last 5 years, but in reality, it wasn't even growth over each of those 5 years. More of the growth in prices and the upshoot, or rather the expensiveness of the investments that we can make in multifamily, occurred in the last 2 years. But as far as the correction is concerned, let's look at household income and see if it's been keeping in line with these growth rates. What's up, Rob?
So I'm curious, can you please explain calculate this price divided by rent equation? Because
Yes.
I'm not figuring it out, and I'm using a calculator.
Yeah. I'll send you the spreadsheet afterwards. But reason you're not getting it out is because what I did was I took all of Austin, and instead of dividing it by 1 bed or 2 bed, I added 1 and 2 bed together, because those are the most common types in most of our multifamily assets. So it should work out to where all of Austin divided by 1 and 2 bed together, because I didn't want to do just 2 bed or just 1 bed. 1 and 2 bed are the most common, but it's not an exact calculation. It's more of a relative calculation. So that we can compare the growth rates. But essentially, this is telling us, yield, right? So yields have been declining. Right. So actually, I think I did it on a monthly basis, but no, this is actually monthly rent. So it's 1 and 2. So it's price divided by 1 bed and 2 bed in rent. But you could also do annual. The math works out the same in terms of determining the rate, because in both cases one's dividing by 12, one's not. But I'll spare you guys the boredom. DFW is what we need to see next. So
That's boring. Can we skip it?
now, you don't like Dallas?
No, I hate Cowboys. Sorry.
We'll look at San Antonio. But before I go through all 4, I actually kind of want to take a quick poll. Okay, so I'm going to ask you guys a question. Of the 4 cities, which one do you think produces the highest rate of return? Okay, so if you think your yield and growth, your total return. So whether it comes from yield or whether it comes from growth. So what do you think it is, Gaurav?
Austin? Well, over the last 5 years, at this time period, or?
Yeah, over the last 5 years. Austin? Why do you believe it's Austin?
Because I can't afford anything in Austin.
That's true.
We'll see. But no one said San Antonio.
San Antonio?
Oh, San Antonio. Okay, sorry, from the get-go. But what's interesting? Oh, we're not looking at Dallas yet. So population will tell us. But now there's Dallas. So pretty much the same data sets. Asset prices have increased at a similar rate. But what I was surprised by was the rent growth. It's actually not too far off from how much rents have grown in Austin. So Austin, we all know rents have skyrocketed, but Dallas has grown at a pretty good similar rate. Houston, that's where I'm from, but unfortunately, those rents just haven't climbed up as much. And I'm sure there's a number of reasons of why, but Dallas and Austin essentially almost 5% a year of rent growth. And lastly, our favorite, San Antonio. So San Antonio, rents have been growing at a faster rate than Houston, but just under Austin and Dallas. Asset prices, again, we're seeing, 10, 12%. So across the board, asset prices have been going up. It doesn't matter if one city has been growing at a faster rate in terms of rent. The price you pay to buy into that asset is just harder and harder to find good deals. So now we'll look at population. If we think of our total return as Gar was hinting at and asked, very astutely, what do you mean in terms of return? I mean, it's essentially going to come in one of 2 ways: either your yield, the dividends or distributions paid to you, or the increase in the price when you sell it at the end. So we'll break those 2 down, right? Yield comes from higher incomes. So what contributes to higher income? It could be what higher income to us as investors. So what contributes to higher yield? It could be that the folks are making more money and demanding more upgraded units that they want to pay for. But it also could be that there's just more folks moving into a fixed area where there's a fixed supply of housing, like we've seen in Austin and Dallas as well. And so they're bidding up the prices. So population growth is important to us for the obvious reason that, I love Beaumont. I hope no one here is from Beaumont, but would I invest in Beaumont? I don't know if you guys have been there. I have for some development projects, and it wasn't actually development. The city of Beaumont was paying us to tear down homes. So the opposite, because they had so many homes that were vacated from just job loss and no industry growth that they weren't collecting property taxes, and it was an eyesore. So point of the story is that's also another caveat, is be aware of the yield trap. What I've found in Houston, for example, Brian might be able to relate, is you know, I have found properties that will yield in the single family space over 10%. And when I go out to drive to those areas, I know why it's such a high yield. It's because the area has no growth whatsoever. So to each their own, but no matter how high the yield, if there's a risk that my original investment will decline in value, that's why it's selling at a higher yield, is to compensate for that decline in value. But the graphs are nice, but let's get straight to the point. So now we have all 4 cities and we can compare the two. This to me really tells a story. And what I find especially interesting is if you notice just the correlation. And so why we believe, population growth is such a good indicator of rent growth. So for example, the fastest growing city in terms of rent is Austin. Coincidentally, the fastest growing city in terms of population is also Austin. The next fastest population growth for one of our 4 cities is DFW, which is also growing at the next second highest rent growth. And then San Antonio, and then Houston. So, and it helps in our underwriting. If you have 2 assets, similar yield, but one has a higher growth projection, we can just back test, does it have a higher rate of population growth? Because then it does justify. The other thing it tells us is Austin is more expensive, but for the other obvious reason that more of your return is coming from growth. So it's growing at a faster rate. So you might sacrifice yield, but you're getting more growth. To each their own, whether you're a yield or a growth investor, I would never say one is better than the other. I'd prefer to have both in every investment. There's definitely some distinct advantages. If you have yield, you can continuously reinvest that distribution or dividend every quarter, which really does add up over time. You're essentially getting the effect of compounding interest, but you're also paying taxes every time you receive a distribution. Whereas with growth, all the gains that you're getting, you haven't liquidated yet, you're not paying tax. So it's growing tax-free. So different ways to look at it in your calculations. But essentially, Austin's way more expensive. So that might turn people away. But is it justifiable? I mean, it would suggest so if the rent is growing at a faster rate. The other thing that I found was interesting was, if you see here, and I think this is an example of just the efficient market hypothesis. So essentially, there's that academic theory that all markets are efficient. If there is a good deal, it won't last for long. People like us in this room will go and chase it and bring it back up to where essentially they all converge to the mean. So, we saw stuff, for example, Houston was significantly cheaper. And that's, you see then the prices are growing at a faster rate so that the returns catch up to that 70x rent valuation multiple. So markets are fairly efficient. Basically tells me the story that, hey, 5 years ago, Houston would have been a good bet, but all the investors tapped into it and brought it up to where now our valuation multiples are pretty much all in the 70s. That's population, but now we want to go and address that question as far as affordability. So rents are going up, we all know that, but are people actually making more money? And investing aside, is much bigger problems we have if folks can't afford a place to live. So these are the median incomes. Fortunate to see that in every single city, they're going up, and they're going up, considerably. So that's again our price growth and our rent growth. Then over here we have our income of the actual. So this is the median household income in each city. So interesting to note, Austin, the median household income is significantly higher than Houston, DFW, and San Antonio. So there's definitely, just a lot of wealth creation going on in Austin. It's just leading the rest of the state. And now we address that question of affordability. So this is 5 years ago. It's a little bit, so I took 2017 incomes over, no, 2017, I think it's essentially your income divided by your rent. So basically what it's telling us is, on average, rents are at 30% of household income. So essentially 1/3 on average of the renting section of the population, they're paying out 1/3 of their income to rent. Question is, did that change over time? So now we address the question of, is housing becoming less affordable? So again, this is just the data from CoStar and the Federal Reserve. And it's actually suggesting that it's as affordable back then as it was. Essentially 33% today, between a 5 years difference. So the income's 5 years later and the rent's 5 years later versus 5 years ago. It's still making up the same proportion of their income. There is one caveat about this, and it kind of is a self-fulfilling prophecy, because for apartment complexes, the property managers, the general rule is 3 times rent. So, it's a little bit of a self-fulfilling prophecy in that most apartment complexes will not accept a tenant unless they prove income that's 3 times their rent. And so it's a standard for a reason. There may be opportunities where folks could, charge more rent, apartment owners, to take up more of the income of the tenant. But, it's just certainly not a strategy that I don't think anyone wants to be that person. And, it's a standard for a reason. You'd also run into other issues, collection issues, vacancy issues. So it's just not an approach to take. But the good news is, hey, although rents have been going up, so too has income. So there's questions, but also just want to add, it's not all doom and gloom. I don't think there's a loss of wealth creation potential in multifamily. I do think it's harder to make the same rate of return as you could in the past, but rents and income continue to go up. And there's also certainly, a need for new housing, to add new housing stock to the supply of homes for people out there. So, what I would say actually is, it's also a question of just where are we in the economic cycle. So a lot of money has been printed, and for a long time, interest rates were very low. So people were able to borrow more and more and more to buy assets, which helped to bid up the prices. That then results in inflation. So we are where we are now, where in order to combat that, we have to increase the interest rates, so that now, prices are not as hot as they used to be. I think we used to underwrite selling cap rates as low as 2% for multifamily, 3%, believe it or not. Now it's in the 4% and above range. And honestly, just adding a margin of safety where we don't expect to sell any of our assets for any less than a 5% cap rate. Will that continue going forward? It depends on where interest rates go forward, and we'll see. But yeah, in a nutshell, curious questions, but also just what other folks want to add. Gaurav, I know you have experience in multifamily. Brian, how does this compare to single family? Rob, what are your thoughts here? But anybody in terms of questions or just stuff they want to share with multifamily or real estate in general? Yes.
What have you seen on cash returns? And I don't know if you've had time or not to actually gauge this, but I personally have noticed as a passive that, I don't know if this works, that of course you're lucky if you get double-digit returns. And a follow-up question is, more and more investors now, I know back in the day, they would give you cash on cash return on your, your enticement sheet, if you will, your offer. And now they're more now giving you the annual rate of return. Is it because they don't want you to see as a passive how low the cash on cash return is?
I mean, I can't speak for other folks.
I'm just wondering what you think.
Yeah. By cash on cash, do you mean like the end sale value over your original investment or your annual yield?
No, I'm not concerned about that. I want to know what my cash on cash return is so that I can compare apples to apples. Because some people used to give you cash on cash, and now more now they're saying the annual rate of return, as opposed, they're not giving you the cash on cash return.
It might be, and this is just my guess. Curious if any other folks have any experiences or explanations, but it might be that it's just harder to gauge now what we're going to sell for. I think in the past, everything was just going up and up and up. Now, especially with interest rates rising, your buyers at the end, which is what determines your cash on cash, they're facing risk of rising costs of interest rates. So they're retrading on their offers. They're coming down. So it's harder to predict. And if it's harder to predict to a potential investor what the number is going to be, probably just leave it off and say, we don't know what it is, but maybe annual yield is something we can be more accurate about because that's our cash flow today. Maybe that's why. Yes, sir.
So in response to her question, if you're talking about multifamily investments where it's a syndication typically, most of those are offering a pref return, which is just a return that the syndicator is going to provide to their investors. They don't usually quote a cash on cash typically because there's so many expenses going into acquiring a property that they're giving you a pref return, which means they don't have to pay it, they can accrue it, pay you later, pay you at refinancing. But cash on cash is implying a certain yield that's pretty hard to predict when interest rates are going up, construction costs are going up 20 to 50%, supply chain means you might have to wait 6 or 8 months or more for materials or appliances. So most syndicators, or even just true owners, are being a little more circumspect or holding back from promising a certain return in the short term, like annually, but over the life of the property, maybe 5 years, they can predict that a little bit more normally based on just that elapsed time.
Definitely. Yes.
So how would you compare your deals? You get all these offers from all these sponsors. How would you compare your deals?
I think
The better return.
so. Me personally, just in general, the first thing I look at is how much of the return is demonstrated by historical cash flow versus the expectation that we're going to get higher rents and we're going to be able to produce significantly more cash flow than this asset has demonstrated in the past. So there's the academic theory of how you measure risk, which is beta and whatnot, where it's the volatility of the stock price. For me, the way I measure the risk of an investment is how much of my return is predicated on future projections versus demonstrated by historical yield. So if you present me 2 offers, for example, one is 10%, and it's 60% of the return is based on yield. The remainder is from growth. Whereas another is 11%. Okay, it's a higher return by 1 percentage point, which is significant. That adds up over time. But if that investment is based more on us being able to sell at a higher price without necessarily increasing cash flow or demonstrated historical cash flow, then it's a riskier investment. So basically, that's the first criteria for me, is just evaluating, historical performance versus projection in the future. And I'll take demonstrated historical cash flow any day over projected growth. But at the same time, to answer your question, how I would evaluate, there's clearly different approaches in different markets. So for example, in Austin, of course, I would lean more towards growth than I would in Houston, for example. I'd expect more yield from my investments in Houston in general. Certain deals in specific areas can completely portray a different picture. But in general, I might adjust my approach based on where I'm investing. Development, for example, at Upside Avenue, we have a development project in San Antonio. It's not producing any yield for our investors currently, but we know there's money in it. We know that people keep moving to San Antonio. We know the land value is going up, and we know that they need more places to live. And it may take another 2 or 3 years for us to complete that complex. So in that case, of course, I'm not going to look at yield. So those are a couple of different ways. I don't know, anyone else wants to share kind of how they evaluate and compare different deals?
I have to weigh in on what you're saying. You're speaking as an owner. And a lot of people in this room may be more investors, where they're depending on somebody else and they're in a passive role. Number one is always evaluate the syndicator or the sponsor. I don't care how good their numbers look, always evaluate them, because you're relying on their assumptions of how that property is going to do, how they're going to perform. That's your number one criteria. Then you look at the property and see if it fits with something you would feel comfortable with, not necessarily living at, but just feeling comfortable with the asset where it's at. Then number three, look at the numbers. As you gain more experience, you'll be able to look at their assumptions and make opinions of value. But as you first go into these things, you're depending on the reliability and the experience of the sponsor.
Very true.
Thank you.
Very true. Yes.
Rosch, I got a question. I'm sure you might have a answer, maybe.
Sounds interesting, man.
There's a party out in New York called the Rent is Too Damn High party.
Yeah.
And I'm kind of scared of the collectivization of renters. Do you see like a possible movement of renters coming against property management companies saying, hey, we don't want you to buy our apartment complex and raise the rents? And like, how would that look like? You think? Have you ever dealt with anything of that nature with people opposing property manager companies like us, investors?
Yeah. So for better or worse, no, I've not personally dealt with that. And I'll take it back to the affordability slide, where those incomes have gone up as well. But there's actually a really good kind of side note on that, which is essentially, if you're stuck renting, you don't get to own assets that appreciate over time, whereas expenses continue to go up. So I think this contributes to the greater economic inequality. But there's also a shift where lucrative investments, for example, multifamily, which has historically been a very high performing asset class. Traditionally, you needed at least 50 grand to invest in one of these programs. Traditionally, you had to be an accredited investor. Stuff like Upside Avenue, for example, because of the Jobs Act, you do not have to be an accredited investor to invest with us, and you can invest for as little as $2,000. So my point is, you can be a renter, but still be an asset owner to kind of offset the fact that, okay, if rents are going up, hopefully your wages are also going up as well. But whether they are or not, you can still participate in these investments. So you could literally be a co-owner in an apartment complex that you live in, so that you're also participating in the wealth creation that comes over time from owning these assets, to build your own wealth. So that's kind of one. I'm not answering whether it's good or bad. I certainly don't want to get political on the matter. And more importantly, definitely a proponent of just economic prosperity for everyone. By no means do we want to see more folks getting priced out or having trouble to pay. And at the end of the day, if folks cannot afford to pay their rent, investors suffer as well. So it's all interconnected one way or the other. Yes, sir.
I think there's a good example right down the street. There's a mobile home park that's there. It was bought by a big operator 5 or 6 years ago. And that group of renters said, you're about to raise rents too much. We think it's unreasonable. They convinced the city of Austin to give the property to them or allow them to purchase it as a co-op. And what happened is about a year and a half later, they had to raise rents even higher than they intended. Because they realized this is really hard and costs are not. I think we'll find a lot of people as they dig into this, like to operate these stuff.
Yeah, and I also, I also want to add, at least because I can speak for Upside Avenue because I'm intimate with those details. I don't know about other multifamily operators, but with the case with us, when we buy an apartment complex, for the most part, we're only raising rents after we've renovated the unit. So we put in brand new kitchen. We'll put in USB outlets in the kitchen, create some tech packages, put better access to Wi-Fi, upgrade the system. So I think there's something to be said about, are you charging more in rent but not doing anything? Or are you charging more in rent but you're way more responsive on maintenance and you're genuinely providing a better living space? For example, we've also started to implement dog parks in a lot of our communities. So people are paying more, but because we're providing more. They're paying more because they want something more out of it. And fortunately, in most of the case, they can afford to do so. So we're happy to provide. But I feel like I'm running for political office or something. Gaurav, I know you have some interesting stuff, but I kind of want you to share your experience with multifamily because I feel like it could be pretty helpful with the room.
Sure, yeah, happy to. Hey, everybody, my name's Gaurav, friend of Rosch's, as he so nicely called me out. I can share my experience. I come from a multi-generational real estate family back in India. We've been buying land for many generations, so I lived there for about 10 years and saw the wild, wild west of real estate with respect to owning land in villages across the country. Where here we're lucky enough to have a state register where if you own a piece of land, it's recorded. No one can change that register. Versus many places around the world, when you own land or any type of real estate, it's recorded in a book that sits in an office. And we've had experiences where people with machetes will go into that office, pull out that book, rip out those pages, say that my family or us don't own the real estate. We've had to send guys with bigger machetes to change that. So, growing up in India, learning about that side of the business, development, multifamily, land ownership, gave me a real appreciation for what real estate truly means and what's the point of it. I forget who it was, I think it was you, sir, you alluded to it earlier. The biggest benefit of real estate is to build wealth for you and your family over time. I don't think it was necessarily as income or anything else. It's just building wealth in a way that another asset cannot, because real estate, you can use leverage. It doesn't matter who you are. You can borrow money and you can use that to amplify your returns, whether it's $2,000, $200,000. You can't really do that with stocks, with cryptocurrency. If you're investing in startups, it's a lot harder. I think every one of us in this room can do that with real estate. So I grew up very passionate about real estate. When I came here, I started in banking, just like Rosch did in Houston, and got the opportunity to work for a property management company that's based here in Austin. It's a single-family property management company that's now the largest single-family property management company in the United States. We manage single-family homes on behalf of institutional investors.
And it's only $99 a month.
It's $99 a month, that's right. But that's, so, many want to use property management. I'm happy to talk to you after this, but, sorry? Flat fee.
You caught Brian's ear.
Brian's ear, that's right. It's called Darwin Homes.
How much do you charge you have to
75% of 1 month's rent.
I'm sorry, Gaurav. I know you're going off into something, but $99 a month. That's all we want to know.
So it's funny you say that because this company was started 4 years ago by one of the founders of a company called DoorDash, food delivery company. They moved to Austin, saw an opportunity in real estate, and they started, with this offering of $99 a month flat fee, 75% of 1 month's rent as a placement fee to find a tenant. And we grew that business to about 1,000 units with retail owners like yourselves or anyone in this room. And then since then, about a couple of years ago, we pivoted to start working for institutional owners. So mostly, Wall Street funds that are buying not 1 or 2 homes, but thousands of homes across America. And now those are our primary customers. And so we see things, like you mentioned earlier, around tenants having issues paying rent in 35 different markets around the country. So I've been in this space now a few years, learning a lot about how it works. And on the side, I've also started a fund where me and people in my network, we buy small multifamily assets in and around Texas today, and manage the assets ourselves, cash flow them,
put CapEx in, like Rosch mentioned, and now we started selling. I think the market's at a point where, it's good to take some money off the table. So that's what I'm doing now. Hopefully I didn't go on too much of a tangent, but that's my experience with real estate, and it's been fun so far. Rosch, did I do everything you wrote and dreamed?
Yeah, wonderful. I'm just trying to take the attention off of me. On that note, Kim, I saw your hand up.
Do you have any projections?
What's Rosch's crystal ball for 2022 to 2027?
My lawyer has advised me that when asked about projections, run out the door. So,
He's not here today.
We tied them up.
I mean, okay, there is something that I want to say about that. It actually does bring something. And it also goes back to, the housing supply and the affordability. And, one way that we can be a part of the solution, as opposed to the one way we can be a part of the solution would be to add to the stock of housing supply. So if you ask me about projections, I'm not going to make any predictions as far as where rent prices or asset prices are going to go because I have no clue and I don't want to get sued. But more importantly, what I'm getting at is not necessarily projections, but shifting one's strategy based on where we are in the economic cycle. So if it's getting more and more expensive to buy existing assets, light bulb goes off. Why don't I start building and developing? So Upside, for example, the portfolio has traditionally consisted of income producing, value add, existing properties that we buy and rehab. But we have that development project in San Antonio, yours truly, for the reason that, hey, if asset prices are going up, my prediction or rather forward-looking suggestion would be, shift your strategy. And like you were saying with the operator, look at an operator that has experience in both. That's not just a one-trick pony, not a knock on anyone else, but just where we're trending towards the top of the cycle. In many cases, folks believe we're already at the top of the cycle. Somebody that can play both angles will prevail in the long run. So long-winded answer, also kind of avoiding your question, I'm sorry, but anybody else? I don't know how we're doing on time, Katie or Sarah. Oh boy, more questions. Yes, ma'am.
Depreciation. Are you guys, are we getting a K1 the first year we invest with you?
Very good question. Muhammad was grilling me on this earlier. So Upside Avenue is a REIT. Let me take a step back first off. I'm not a certified public accountant, so don't take this as any tax or accounting advice. But my general understanding is a partnership, a pass-through entity, like an LLC, for example, can pass off its depreciation to you on your individual K1, which can be quite advantageous because it'll lower your overall income, reduce your taxable burden. In the case with REITs, like Upside Avenue, for example, being a REIT, we're structured as a corporation. In exchange, the deal with the IRS, the whole point of being a REIT is that you don't have to pay income tax at the corporate level, but we also can't pass off depreciation. So you just can't have it all. To answer your question, at least for Upside Avenue and other REITs in general, they issue 1099s, which is your corporate return, as opposed to a partnership return, which is your K1. And in corporations and 1099s, there won't be any bonus depreciation that's passed off to you. Mm-hmm. Yes.
Rosch,
Oh boy.
what are your thoughts about the Dallas Cowboys? Broke his arm. Fish.
As you can tell, I'm pretty much a finance nerd, so I'm really not following along with what's going on with the Dallas Cowboys. But I can tell you what's been going on with the rent prices in DFW.
That's fair.
Around the Dallas Stadium.
What happened? It unless you're playing the sports. What's up?
It sounds like you've had some experience with both development as well as buying existing assets and operating, right? So I'm just curious, forget the returns for a second, forget the yield, et cetera. Which one did you enjoy more? What were your experiences with both? Because they're very different opportunities.
Absolutely development. Just from a personal perspective, building something, creating something. There's 3 buildings in downtown Austin right now. Now they're restroom buildings, so it's not the most exciting use, but they're there. They'll be there for a very long time. And every time I'm in downtown Austin, I can walk in and look and say, I put up that building. not by myself. Fortunately, there was a team of folks and workers that we all put it up together. But development is way more fun. It's also a lot. Now, that's from a personal standpoint as far as what I'm involved in. But I would say from an investment perspective, development is a lot riskier. So I would never exclusively commit my capital or the real estate section of my portfolio to development. Even though there's higher returns, I would definitely balance it out with value add. So long about way to answer your question is both. And I think in every case, the cop out is just diversify, and it's a cop out for a reason. It's fairly a good strategy.
Okay, so how long did it take from start to finish to build those buildings? And how much did your cost escalate during that time?
Good question. Good question. So this was back in 2019, 2020, and 2018. And restroom buildings. And those were the ones in Austin. Yep, in the parks. And then there was an industrial building way out, about 30 miles out of Fort Worth, and commercial garages for the airport. But to answer your question, all of my buildings were prefabricated, so my construction time is drastically reduced. The likelihood of me overrunning cost is also drastically reduced. But what happened was, like everything else, prices shot up during that time frame, and many of my buildings were metal, so my manufacturer was rising his prices, and I didn't lock it in. And my customer was the city of Austin in that scenario. So the city of Austin doesn't mess around. Once you have a bid under contract, you can't go back to them and give up change orders or price escalations. They don't care. Fortunately, I had enough margin of safety, so I still made a profit. But it eroded half of my profits on that project. To answer your question.
Of course, the city council can vote themselves a 40% pay increase on their own vote, right? Just a couple of weeks ago.
Oh, really?
Give you any break when you're a contractor?
No. Fortunately, not a contractor anymore. With Upside Avenue exclusively, but definitely a lot of respect out there for the folks that are actually building things with their hands. It's extremely important.
Alrighty, got about enough time for one or two more questions, but then we're gonna wrap it up.
All right.
Alrighty.
Yes.
All right, last one.
All right, last one. I'm kind of curious with your thoughts with Elon Musk and the Boring Company. Do you see that changing real estate values a lot, or you don't want to touch that yet?
I'm kind of curious how you come up with these questions.
Well, I'm just grabbing out thin air. I see like tunneling changing real estate values here and there, but because you can move more people through various areas. And in theory, more people in a certain area means more value.
So I don't know about that question in specific, but it does remind me of another trend that we're experiencing, we're the beneficiaries of. So as you said, if people are able to move around more frequently, and if we're able to dislocate where they work from where they live, does that change real estate values? And absolutely it has. So essentially, because of COVID, this whole work from home phenomenon has now taken off and is commonplace. So what we've seen is, the Sun Belt, Texas and states north of us, the more affordable states have now become more attractive and have seen that population growth from folks on the coastal cities where it was particularly expensive, but now they're no longer required to physically live there. So they're adding to the population growth. So if you kind of think about like a bunch of water in a tank, you can shake it around, eventually it will level off. And so you're seeing not necessarily that the prices in the coastal cities are declining, but they're not growing as fast as they were previously, like New York or San Francisco. And Sunbelt city prices are catching up, which is, what we just saw for ourselves. So again, markets are pretty efficient. If there's a discrepancy in arbitrage opportunity, somebody in this room is going to capitalize on it, and it's not going to last for long. I guess that's it. One more question.
If we have one, yeah.
Dwight, Cameron, anything y'all want to add? Good. I have a question. Is there any pizza left?
Absolutely, yes.
All right, good.
All right, let's give a big round of applause to Rosch.
Alrighty.
Thank you so much.
Yep.
So now is actually the part of the night where going to move pretty quickly through this part. But if you do have a deal or a service that you want to come up to the front and take the mic and pitch it to